For years, the crypto industry marketed the cold wallet as the ultimate fortress for wealth. It's a physical, offline device that stores private keys entirely disconnected from the internet, supposedly making it unhackable. But that sense of security was shattered when hackers stole over $100 million from users of a brand called Coldcard. Crucially, the physical devices were never breached, and the funds weren't taken through a traditional hack. The vulnerability was actually hidden in the device's internal logic. A mathematical error in a formula from 2021 meant the passwords generated by the device were predictable. Hackers didn't need to touch the hardware, they just needed to run the math. Millions of dollars in user funds were vaporized because the industry's primary offline security measure was defeated by its own code. When victims reported these thefts, they discovered there is no safety net.
Because this ecosystem lacks federal oversight, there is no FDIC insurance and no regulatory authority to freeze the stolen assets. Legal recourse is just as limited. Coldcard's terms of service effectively block major lawsuits, meaning a user who lost millions might only be able to recover the $80 purchase price of the device itself. This chart tracks a specific migration occurring in the wake of the exploit, a flight of coins into centralized exchanges. Some users, finding self-custody too risky after seeing a hardware flaw lead to an unrecoverable loss, are choosing the oversight of regulated custodians. The industry is facing a hard truth. To retain users and survive, it requires the exact government-regulated protections it was originally designed to bypass. This shift has turned the industry's attention to Washington, D.C., looking for a regulatory framework that can provide institutional stability. The primary solution is the Getting Clarity Act, a 616-page bill that would establish consumer protection standards and give law enforcement more tools to pursue digital theft. The bill is stuck in the Senate, needing 60 votes to end debate. But the Republican math is tight. Despite a 53-seat majority, opposition from Josh Hawley and Rand Paul, plus Mitch McConnell's absence, means they can't reach 60 alone. Because of these internal parnell holdouts, the fate of the entire market framework now depends on whether the bill can attract at least 10 Democratic votes. The primary obstacle for those 10 votes has little to do with the bill's technical merits. Instead, the negotiation has stalled over political optics. Democrats are demanding a specific ethics clause designed to ensure that Donald Trump cannot personally profit from the digital asset industry while in office. Their demands include requiring the former president to divest from his current crypto holdings and granting state attorneys general the power to prosecute federal officials for ethics violations. The White House has offered to place his assets in a blind trust and cease issuing new tokens, but Democratic negotiators currently view this as insufficient for their campaign messaging. The technical consumer protections are currently secondary to the utility of this ethics clause, as both parties look to leverage the specific language for their upcoming midterm campaigns. There is a hard deadline approaching. On August 7th, the Senate breaks for recess, which effectively ends the window for any procedural action this year. Once lawmakers leave for the break, their focus shifts entirely to the midterms. Any bill that hasn't cleared the floor by then is essentially frozen. If the bill misses this window and the balance of power shifts after the election, the entire framework could be discarded. As this timeline shows, it might not be resurrected for several years, potentially pushing federal regulation to 2029. Every day spent debating campaign ethics is a day that the U.S. remains without a clear path toward becoming a regulated hub for digital assets. These two realities are happening at once. While D.C. negotiates campaign optics, everyday investors are losing their life savings to mathematical exploits they have no power to stop. The era of a purely decentralized financial frontier, once a beacon of absolute freedom, has finally reached a hard structural limit. To achieve any mass adoption, digital assets must move away from the Wild West model and integrate with established legal and centralized frameworks. The underlying technology and the code are functional, but the industry's long-term integration into the U.S. financial system rests on the signatures of politicians.